Welcome to the Deep Dive. We take the sources you need to understand and really pull out the crucial insights fast.
Exactly. We know you want to get the core of complex topics, but without, getting totally lost in the details.
And today, we're diving deep into a really foundational document in finance. Warren Buffett's 1957 partnership letter.
Yeah, this letter gives us a fascinating window, really, into the early days of a legendary investor. We'll be looking at his market perspective then, his strategies.
The actual performance of those first investment partnerships.
Right. And our mission here is to kind of unpack the fundamental principles guiding his thinking in that specific market environment.
Okay, let's get right into it. Buffett's general view of the stock market back in '57. It sounds like he wasn't exactly wildly optimistic.
No, not at all. In fact, the year before 1956, he had already said the market, particularly the big blue chip stocks, looked overpriced relative to their intrinsic value, their real underlying worth.
And he doubled down on that in '57.
He did. He reiterated that concern, basically saying he didn't think current prices would look cheap 5 years down the road.
Okay, so seeing elevated prices. Not predicting a crash, maybe, but definitely cautious. What was his plan then?
Well, he laid out a couple of possibilities. If the market took a significant dip, making good companies cheap.
Bargain hunting time.
Pretty much. He expected to buy more general issues, his term for regular undervalued stocks, maybe even borrowing money to buy more if things got really cheap.
And the flip side, if the market kept climbing.
Then the plan was to ease off those general issues as they hit better selling prices and shift more into something he called workouts.
Workouts, right. We need to unpack that term. But first, it sounds like the main takeaway here is he wasn't trying to time the market, was he?
No, exactly. He was very clear that forecasting market swings wasn't his game. His priority, consistently, was finding companies trading well below what he thought they were truly worth.
That value investing bedrock was already solid.
Absolutely. Firmly in place.
So, moving into 1957 itself, the market did dip, but maybe not as dramatically as some felt. What happened?
Yeah, he called it a moderate decline, and he used that word moderate carefully, suggesting that maybe people, especially newer investors, were overstating how bad it was.
That's interesting. Perception versus reality in the market. Did he say why he thought it was only moderate?
Well, he observed that stock prices seemed to fall less than corporate earnings power did, given the economy at the time.
Meaning?
His take was that the public was still pretty optimistic about those blue chip stocks and the economy overall. There wasn't panic selling,
And true to form, he didn't try to guess what was next.
Nope. He explicitly said he doesn't predict the economy or the market. He just wanted to give a factual take on what happened and restate his view. The general market still looked pricey long term.
So focus on valuation, not forecasting. Got it.
That's the core insight, really. Present value versus long-term worth.
Okay, so the market is down a bit, potentially creating more opportunities. Let's circle back to those workouts. How did the '57 conditions affect his use of those?
Well, interestingly, that moderate decline actually created more opportunities in what he called significantly undervalued general issues.
So more regular stocks look cheap.
Exactly. Companies where the profit comes from, the business doing well and the market eventually recognizing it. Because more of those popped up, he actually shifted away from workouts compared to late '56.
Okay, so define workouts for us. How were they different from just buying an undervalued stock?
Right. A workout, as he explained it, is an investment where your profit doesn't really depend on the whole market going up or even the company's long-term growth.
So what does it depend on?
A specific corporate action, something planned, like one company buying another, a merger, a company selling everything off and liquidating.
Or maybe buying back its own shares, a tender offer.
Exactly, those kinds of things. The profit comes if and when that specific deal happens.
So the risk isn't really the broad economy tanking.
Right. The main risk in a workout is that the deal falls through. Maybe regulators block it, maybe financing disappears, whatever. That's different from a general undervalued stock where a bad economy could hurt the business and the stock price.
Makes sense. And you said the allocation changed.
Yeah. End of '56, it was roughly 70% general issues, 30% workouts.
Okay.
By the end of '57, because more general issues looked attractive after the dip, it shifted to about 85% general issues and only 15% workouts.
So the market dip actually fueled his core strategy more.
Precisely. It gave him more of what he really liked to buy.
Now, beyond the overall split, he also mentioned making a couple of big individual bets in '57.
He did. He flagged two significant positions. One was Pretty substantial, maybe 10 to 20% of the partnership's total assets.
Wow, that's a concentrated bet.
It is. And the other was around 5%. But what's really key is his time frame for these.
Long term, I assume.
Definitely.
Yeah.
He expected them to take maybe 3 to 5 years to play out fully.
And the upside. What was the thinking behind committing that much for that long?
He thought they had the potential for a really good average annual return, and importantly, with less dependence on what the overall market did day to day.
So he acknowledged the potential downside too, right?
Yeah, he noted that if the market went on a huge tear, these value-focused plays might lag behind. It underlines again, focus on the business value, not market momentum.
Okay, let's talk results. The proof is in the pudding, as they say. How did the partnerships actually do in 1957, especially compared to the market?
Well, the Dow Jones Industrials benchmark was down 8.47% for the year, even counting dividends, so a losing year for the market overall.
And Buffett's partnerships.
The three he started in 1956, all positive. Returns were around 6.2%, 7.8%, and one hit about 25%.
25%. In a year, the market dropped over 8%. That's huge. What drove that one standout performance?
He chalked it up mainly to luck and timing, actually. That third partnership started a bit later in 56 when prices were already lower.
So they had cash ready when things were cheaper.
Exactly. They could take bigger bites of those attractive, undervalued securities right when they became available. The earlier partnerships were already more invested. It wasn't different stocks.
Just better timing for putting money to work.
Precisely. He was clear all the partnerships held the same things in roughly the same percentages. The difference was when the capital came in relative to market levels.
That's a crucial point. He even said he'd be happy beating the market by just 10% a year long term, didn't he?
He did, which suggests 57 was unusually good, likely better than his own long-term expectations for outperformance.
What about the newer partnerships started mid-1957?
They came in halfway through the year, so they basically tracked the market's decline from that point on down about 12% since they started.
But presumably holding the same stuff.
Right. He noted their portfolios were aligning with the older ones, so he expected performance to become much more similar going forward.
So, pulling back, what's the big picture on this 1957 performance?
Yeah.
Beating a down market.
He pointed out that, their relative performance tends to look better when the market is weak or falling. That focus on undervalued stocks provides a bit of a cushion,
Defensive, in a way.
In a way, yes. He also said he'd be perfectly happy just matching the market in a really strong up year. So the takeaway is the resilience of that value approach, especially when things get tough.
And looking forward from the end of 57, how did he feel about where the partnership stood?
He felt pretty good. He believed the portfolio represented better value at the end of 57 than a year earlier.
Why? Because prices were lower.
That, and because they'd kept patiently buying more things he considered significantly undervalued. He mentioned that largest position, again, aiming for 20% of assets eventually.
And the strategy for building that big position.
Patience. He stressed it's gradual. And interestingly, he said that having the price stagnate or even dip a bit while they were still buying was actually good for long-term profits.
Counterintuitive, but it makes sense if you're accumulating shares cheaply.
Exactly. It really highlights that long-term focus and willingness to wait.
Okay, so let's recap this deep dive into the 57 letter. We've got a cautious market view, a laser focus on undervalued companies.
With a side of those tactical workout investments when appropriate.
And we see initial performance that really smoked the market in a down year, partly thanks to that value focus, partly due to timing of funds.
It's really striking how many of his core ideas were already locked in place so early on.
Absolutely. I feel like we've gotten a real shortcut to understanding that foundational thinking.
And you see how it wasn't just theory, right? It was a practical playbook for dealing with actual market conditions.
Definitely. Which leaves us with a question to chew on. Today's market is so different. Speed, technology, information flow. How might those core Buffett principles of value and patience still apply? Or how might they need adapting? That's something for you, the listener, to think about.
Thanks for joining us on this deep dive. Hopefully, it's given you some valuable insights into the early mindset of an investment legend.